Hi, and welcome to another episode of Family Office Stories, tackling topics of interest across the industry. I'm delighted to be joined today by Samuel Heber. He's the founder of Equinox Capital, a firm unlocking unique tech-driven investment opportunities in private markets. Samuel's worked across the industry prior to founding Equinox, so welcome, Samuel, to the podcast.
Welcome. Thank you very much for having me here.
It's our pleasure. Can you tell us a bit about what Equinox does, your journey to setting up your own business?
Yeah, thank you very much. So effectively, I have more than 20 years experience in the financial industry. I have actually an international relations background, but then done studies in CFA and Swiss CPA as well. And then worked at PricewaterhouseCoopers, right? That's the place to work, right?
Naturally.
And worked in different asset management companies and obviously in mergers and acquisitions as well. What I've seen through my career is that family offices, typically their portfolio is structured kind of with a significant amount of private equity, but their private equity typically is the business which they built, right? Which they made them where they are today. So this already makes a massive amount of their portfolio, and then they have typically some listed assets and maybe some real estate as well. Whereas the venture capital or pre-IPO investments is typically a fair small amount of their portfolio. And I think there are different reasons to that, and we can come to that later. But I think what we're trying to do is kind of removing some of those barriers to entry, especially because this asset class has performed very well over the last 20, 30 years.
And so I totally agree with you. I think a lot of the families we work with, their private equity is their family business. And you know, if they have a family office, maybe they have one person looking at private equity, maybe even one person looking at venture, but not much more than that. So maybe you could share with us, sorry, I'm losing my voice, why private markets have historically been difficult for family offices to access and how you're helping them.
I think to really understand the whole landscape, you need quite a significant team. So I think information generally is kind of a problem. So if one person alone, they can do some research on certain companies, but maybe not to the extent which you would in order to fully understand kind of what are the companies you want to invest and how are they performing, how the market's performing. So I think information is for sure one of the challenges. The second is access as well. I mean, inherently those companies are private. So which means you need to be in the right networks, know the right people to be able to really get a hold of those, let's say, primary rounds or secondary shares. So I think this is one of the second, and I think the third is also the administration. If you're talking about one person in the team, if they have multiple investments, so they need to follow up. You know, do you have financial statements and so on? So it's a bit of a task, right, to manage that and also decide, okay, when should we exit and how do we find a buyer for those shares? You know, most of the time you will have a very small amount, right, of those companies. And then finding the right people to buy those shares. So I think the overall management of that is quite complex. I mean, so I think these are the typical barriers for those direct investments, right? Then if you go into the more fund side, right? So you would also have some who just contribute, you know, to let's say a venture capital or late venture fund. But there are other challenges, right? So there's typically quite high minimum tickets. Long lockup periods as well. So these funds are typically between 8 to 15 years. So no liquidity during that time. Also opaque fee structures, right? So I think these are all kind of challenges which come around that. And that's why it has been generally probably quite a low allocation.
And I assume the landscape's evolving somewhat, and particularly with how AI can be used in gathering information. I imagine when you're looking at venture, for example, information's not necessarily that easy to come by. How are you seeing that change in the industry?
Yeah, absolutely. I think, as mentioned before, I think information gathering has always been a challenge. I think it has become significantly better over the years. I think AI is one element, but also there are more and more research papers and stuff. We obviously also publish our newsletter and blogs where we cover different companies as well.
Yeah.
So I think generally there are more and more providers who actually try to dissect some of this those companies and provide more information, even though, to be fully transparent, right, they're private companies and some things are just difficult to identify.
Yeah, I mean, I have the sense, and I don't know if it's unfair, that sometimes when investments are made into this area, it's done more on a gut feel sometimes, or a connection that the person has. Is that what you see as well? And is there one thing we talk about a lot is the professionalization of how family offices operate? Is that something you're seeing as well, more rigor being put into where the money's placed? Or do you think there is also this kind of tendency of, well, I met this guy and I like what he's doing, we're going to place money there? How do you see that?
Yeah, no, I fully agree. I think there's a lot of, family offices are obviously led by the family office owner typically, and the UBO, and they have their own past experience and understanding of the market. And I think this is actually fair, right? They build businesses and they know exactly what works and what doesn't work. So they have their personal passion as well, where they may put in money. So I think that makes sense. I think where we're trying to help them is to still dissect it in a on a more lower level. Let's say they're interested in tech. There's so many different tech companies, right? But then kind of breaking it down. And there also we appreciate actually the inputs from family offices if they have experience in certain areas as well.
Yeah. And so if you think about kind of the traditional private equity fund, what you're talking about is quite different. It's more of a deal by deal approach. Can you talk a bit more about that?
Yes. So the classic venture capital private equity fund has a lockup period. I mean, you commit capital to a blind pool, and the GP, basically the asset manager of the fund, they have discretion on deploying the capital. So let's say you commit 5 million, and in a year's time or in a half year's time, there's a transaction coming up. So you receive this letter called a capital call, and effectively you have to wire the money within 5 to 10 days, and that way the fund can close the transaction. So you have to reserve a number of a capital amount in a fixed deposit for a period of time. So this is locked up capital, which at that moment doesn't really work. And then afterwards, it is still locked up in the fund for a period of time. So I think the big advantage of that is that it is a diversified portfolio, which is being managed. So I think this is attractive as well. And to be very fully transparent, we also have a fund like that. So we do both. But I think the difference on the deal by deal side is that actually investors can decide on each individual deal if they like it or not, and they can co-invest alongside us. So we handpick transactions and allow investors, family offices, to participate on those transactions as well. So that way they still get the benefit of, let's say, qualified information, pre-selected, but don't have the, let's say, initial lockup periods. Also, the companies we select are more on the later stage side. So they have a proven business model. They're less risky. They could still obviously not perform as hoped, but that the risk of them going to zero is probably lower too.
I mean, we do quite a lot with family offices around process and cash flow management. And one of the things we see very often is, once you've got quite a lot of lines of private equity, managing the capital calls and the currencies and when they're going to be paid, and even getting the information at the other end of the the reporting side and the tax return side, that it's often quite tricky, I think. So I can see the benefit in a deal by deal approach as well. And how do you see the kind of risk management aspects of your approach for family capital?
So I think the whole portfolio needs to be taken into account. I mean, we typically only cover a very small percentage of their general allocation.
Well, that's a good question, though. So I know no one's alike in terms of how they construct their portfolio, but what percentage would you say is in, we'll call it broadly, private markets?
So I think I'm not saying a specific number here in the podcast, right?
This is not investment advice.
It's not investment advice. Exactly. I think generally we can see tendency toward more and more private equity and pre-IPO allocation. Because the performance has been fantastic, right? And I think it is a very good diversification angle.
Yeah.
I mean, you can see, right, when stocks go down, like typically the whole market kind of goes down, and venture capital, private equity, they just don't react so quickly.
Yeah.
So I think even some companies may be impacted on the operational level, but the stock price is not impacted as quickly. So I think generally it's a good diversification way, and I think what we see is a big change to previously is like, do we need allocation to this? To more like a conversation, how can we manage it properly? How do we invest? Do we find the right partners and so on? So I think the conversation generally has significantly switched from like not feeling it's important to actually trying to find a way to make it work.
Yeah. And I mean, that kind of leads nicely to another question, an area that comes up a lot is how the next gen see private markets. From what you're saying, it sounds like more and more this is important. And is it fair to say that's what you would expect to see over the next 10 years when we see this big transfer of wealth taking place?
I think the younger generation is also more, let's say, open for tech opportunities, and they've traveled a lot, right? They're very open. I think they also want to understand where they invest into. So I think this lends itself well for deal by deal, because they can actually look at the individual investments. And it's also educational piece if you want. So, right, let's say you're 30 years old, you get into that role of kind of, trying to steer your family business or your family office. And that way you can kind of co-invest with professional investors and learn from them and kind of go those steps until you kind of, take decisions entirely on your own. So I think it's a very interesting approach, especially they're very tech focused, I think.
Yeah, and we do see actually family offices pairing up more together and investing together.
Jointly.
Yeah, exactly. So I think we are nearly at the end of our time, but I'll ask you one more question. So if you're investing some of your own money today, and again, not investment advice, where would you be putting it? What's the hot topic that you see?
Yeah, I think right now it's still kind of these tech and AI companies are just extremely attractive, right? I mean, this is, we see it's almost like a industrial revolution yet again, right? I've seen in so many areas. How exactly it will play out is very difficult to say. Also, it's not entirely clear who are the winners at the end, right? And I think it's funny, right? When I talked to the team a year ago, everyone was talking about ChatGPT, right? But I think now everyone talks about Claude, right? And so I think my point is not that I'm saying one is better than the other. I think overall the markets are the products are changing so rapidly. Therefore, it's very difficult to say who exactly will be the winners at the end, right?
Yeah. And from a geographic focus, do you think, is it mainly US skewed, or how do you see that kind of for Europe as a continent? Yeah,
I think right now the US is the leader. I think this is the case, but there are good challengers, let's say, from Europe as well, right? We have Mistral and so on. So there are different companies in Europe who actually also trying to get up to speed, and of course China. But for us, it's for the West, it's difficult to invest.
Yeah. Well, thank you very much for sharing your insights. We're out of time, but it was a pleasure to speak to you.
Thank you very much for having me.
Thank you. And thanks for listening. Speak to you soon. Bye.